The largest bubble in human history is cracking. Look around you, at the glass towers reaching impossible heights, the endless rows of new developments, and the staggering price tags attached to the most basic human need: shelter. Real estate is not just a local market. It is now the single largest asset class in the world, a colossal $300 trillion global market that dwarfs stocks, bonds, and even the combined gross domestic product of every country on Earth. Yet, this mammoth foundation, which underpins the wealth and stability of the entire global financial system, is showing unmistakable fault lines. Analysts are now issuing chilling warnings. A synchronous, widespread decline of up to 40% is not just possible, but increasingly probable across multiple major economies. The question is no longer if it will crash, but when and where the dominoes will fall first. Why are nearly all major economies making the exact same fundamental mistakes simultaneously? Why are millions of ordinary homeowners unknowingly sitting on ticking financial time bombs? And perhaps most critically, why are governments across the developed world so terrified of acknowledging the catastrophe that is clearly barreling toward them? In the next 15 minutes, we will map out this impending disaster, showing you the precise countries facing the deepest. Valuation cuts the devastating timeline of the collapse and the cold, hard truth of why this global property bubble has become simply too big for anyone to save. The sheer scale of this problem begins with understanding the $300 trillion mega bubble itself. Real estate has always been central to wealth. But in the decade following the 2008 crisis, central banks deliberately created a perfect financial storm. The engine driving this hyperinflation was a prolonged period of near 0% interest rates, which injected an unlimited supply of excess credit into the global system. It's created a gold rush mentality, attracting foreign capital seeking safe assets and sparking construction booms that became completely detached from local organic housing demand. The result is a valuation gap that cannot be explained by inflation or wage growth alone. What makes this bubble uniquely dangerous compared to any in the past is its unprecedented global synchronization. Cheap money flowed everywhere, creating a unified interconnected risk where the collapse in one country can instantly transmit economic contagion to the rest. The projection of a 40% crash is not pulled from thin air. It is rooted in historical precedent and current, unavoidable financial realities. Across multiple developed economies, mortgage rates have rapidly doubled or even tripled in a short period, instantly doubling the cost of homeownership for new buyers and those needing to refinance. Simultaneously, household debt has reached historical highs in many nations, meaning consumers have little to no buffer to absorb higher payments. This cocktail has pushed housing affordability to its worst levels in 50 to 100 years in key nations. Furthermore, the institutional buyers' hedge funds, private equity, and foreign capital that once propped up prices are now rapidly exiting the market, leaving a vacuum. All of this is happening just as a massive pipeline of new supply, authorized during the bubble years, is flooding markets where actual demand has catastrophically collapsed, setting the stage for a dramatic repricing. The crisis is playing out differently across the globe, but the underlying mechanisms are the same, beginning right here in the United States. US home prices have been inflated not by organic family formation, but by intense investor demand, treating homes as financial instruments rather than places to live. Now, an acute affordability crisis, coupled with the tightening of credit, means that a significant portion of the buying pool has evaporated. Compounding this, the commercial real estate sector, particularly office buildings, is already imploding, threatening regional banks and setting a disastrous precedent for the residential market. Across the northern border, Canada is the poster child for the housing bubble, holding one of the most overvalued markets on the planet. Its house price-to-income ratios now exceed the peak levels seen in Japan just before its three-decade financial stagnation in 1989. With massive mortgage resets scheduled for the coming years, millions of Canadians will soon face a brutal reckoning. The most systemic risk to the global economy comes from China, where real estate is estimated to account for a staggering 30% of the country's GDP. The defaults of mega-developers like Evergrande and Country Garden are not isolated incidents. They are symptoms of a deep structural crisis of oversupply, leaving behind vast ghost cities and hundreds of unfinished projects that serve as monuments to speculative excess. Meanwhile, in the United Kingdom, rapid interest rate hikes have delivered a crushing mortgage shock to homeowners reliant on short-term fixed rates, causing prices to weaken significantly as real wages continue to stagnate. Down under, Australia and New Zealand hold global records for household debt as a percentage of GDP, making their property markets acutely exposed and incredibly fragile to even marginal changes in interest rates. In Europe, sharp price declines are already deeply underway in nations like Germany, Sweden, and the Netherlands, where the construction industry is rapidly reaching a breaking point due to canceled projects. Finally, emerging markets like India, Turkey, and Brazil are not immune, where rapid, often speculative growth has led to massive overbuilding, with currency weakness acting as an amplifier inflating the size of the bubble when measured on a global scale. The primary pin that pricked this colossal bubble was the pivot in monetary policy, the removal of the interest rate time bomb. Ultra-low interest rates artificially justified unsustainable valuations, allowing buyers to borrow extreme amounts and service the debt cheaply. The moment central banks began to raise rates to fight inflation, that foundational math instantly broke. As rates rise, monthly payments skyrocket, and the homeowners and investors who gorged on cheap credit are now finding themselves completely locked out of the refinancing market. This forces a psychological shift in the market, transitioning from a belief in endless appreciation to a grim realization that values can fall, which triggers investors to begin mass selling to cut their losses. This inevitable flood of supply will be driven by the coming wave of forced sellers. Millions of adjustable-rate mortgages and short-term fixed-rate loans are scheduled to reset to much higher rates over the next 3 years, instantly transforming previously manageable payments into financial burdens that are simply too large for many households to bear. Landlords who purchase properties using high leverage are already facing negative cash flow as costs exceed rental income, forcing them to liquidate their assets. Developers are defaulting on loans, leaving unfinished projects to be sold off in distressed sales. Every single one of these scenarios adds listing pressure to the market, and as indebted households drown, the only option left is to list their homes for sale, driving prices down faster and further. Crucially, governments are utterly cornered and cannot save this bubble. Their fiscal deficits are already at historical peacetime highs, making any significant broad-based stimulus unaffordable and fiscally irresponsible, injecting more cash to prop up housing risks, reigniting the very inflation they are currently fighting. Furthermore, the interest rates cannot safely return to zero without destroying currency value and national credibility. Any discussion of a mass bailout of homeowners or developers is politically toxic and would be met with outrage from the millions who did not engage in speculative borrowing. The system has no easy exit. The tools that created the bubble are now the tools that make saving it impossible. This brings us to the $300 trillion crash scenario, where a 40% global decline becomes a self-fulfilling prophecy. When housing, the largest component of household wealth, crashes, wealth destruction becomes systemic. Consumers feel poorer, stop spending, and global recession becomes unavoidable. Banking stability immediately comes into question, as the collateral backing trillions in loans, the property itself suddenly drops in value. The once booming construction and home furnishing industries will see massive layoffs. This catastrophic sequence feeds into itself, causing a collapse in consumer confidence that ensures stagnation and decline continue for years. This is not merely a financial blip. It is the $300 trillion Japan 1989 pattern repeating itself on a global synchronized scale. Looking ahead, we can map out a definitive timeline. The years 2024 to 2025 represent the calm before the storm. Prices stall, credit tightens, and transaction volumes collapse. The critical turning point arrives between 2025 and 2027 as the massive wave of mortgage resets hits, triggering the forced selling we've discussed. 2027 through 2029 is projected to be the peak of the global synchronized decline, where all major markets fall in unison. Beyond 2030, the world will enter a multi-year stagnation phase, with the duration and depth depending on the regional debt levels and governmental response. This multi-year slide is exactly what Japan experienced, and this time, the entire world is on the ride. A $300 trillion asset class cannot fall quietly. This is the final, undeniable punchline. When real estate crashes, everything crashes. It is the bedrock of global financial stability. Its decline will destabilize banks, destroy jobs, bankrupt governments, and fundamentally reshape the entire global economy for a generation. Your preparation must not be rooted in fear, but in cold, rational understanding. This event is coming, and knowledge is your only true defense. In the next episode, I will reveal the 11 definitive warning signs that your specific housing market is about to enter its terminal phase of decline, highlighting the exact countries that are already entering. Phase 2 of this global collapse